Bienvenue à la Retenue, le podcast qui traite d'éducation financière et qui vous évitera de devenir un cancre financier. Aujourd'hui, c'est notre épisode en anglais pour la saison. Today, Steven Furtado is in the house. Chartered Investment Manager, Distinguished Advisor of the Year in Canada, Steven is a phenomenon in his field and a master at social media marketing. But first, let's talk a little bit about my opinion. Can you afford to retire? The answer is more and more likely to be no, especially for those old enough to ask themselves the question. Inflation is eroding the real value of our savings. Higher interest rates have caused a repricing of bonds and stocks. The result is that the assets many future pensioners are hoping to live off of has measurably shrunk. As populations age and the number of workers for every dependent falls, those retirement savings come under pressure. A problem often referred to as the pension time bomb. The bomb may be about to go off. The soon-to-be retired are often advised to shift their assets into bonds and out of stocks as they prepare to stop working to protect their savings from big stock market corrections. Pension funds are usually invested almost entirely in stocks during their owners' younger years, a strategy meant to capture the higher returns that listed equities tend to generate over long periods. As workers near retirement, these funds usually move most of their equities for government bonds, which are supposed to hold their value. But results have been appalling. The typical portfolio actually of those closest to hanging up their boots has lost 17% year over year. What should the younger generation be looking at? What should people closer to retirement focus on? We are now living in a new context, and this means new ideas. Let's get started. You're in detention. Hello, welcome. This is La Retenue, a special episode in English, one time per season, and it's this time we are here with Steven Furtado. Steven, how are you?
I'm well. I'm excited to be here.
Thank you for being here.
And I wasn't expecting to be back in detention so long after leaving school, but it feels a lot like home. I'm happy to be back.
That's good. Why, were you in detention a lot as a kid?
I would say I was a pretty disruptive, or I should say distracted student, which inevitably leads to detentions.
Very good. So speaking of disruption, Steven, we're living in a time of disruption. But before we dive into that, maybe talk a little bit about yourself. So where, how have you gotten to where you are today? You're a certified investment manager or chartered investment manager. This is not a designation that many people have, at least not many people I know. Mm-hmm. You've been recognized in the industry of investment and financial planning quite frequently. You often appear on a lot of social media posts. You do a lot of education and events. You're someone that's recognized as knowledgeable in this field. So tell me a bit about yourself and then how you got to where you are today, and then we'll dive into the whole question around what to do now with our funds, our investments. What should someone close to retirement be doing, and what should someone certainly in their younger years, starting off in business or starting off in life as a professional or just starting off period, what should they be doing? A lot of questions.
That's a lot of questions. Yeah. Look, I mean, a bit about me. How I got here was inevitably started in a family business very young, grew up in that and learned about money kind of the harder way, earning it because nothing was given to us. So earning our money, and then after being very frugal as well, immigrant family type of story, so about saving, about investing, cash under the mattress type of generation. I did that for many, many years. It was a family-run business. Was very happy to work alongside my father for so many years. We get along great. We still get along great, which is, I don't think a lot of people can say that about their family businesses. But yeah, I'm very fortunate for that and have a very good family dynamic altogether. I relate very closely to business owners. I've seen a lot of what entails, a lot of the pain points that business owners feel. Family business is a whole other beast, but just from a business owner perspective, spending, I might be young, but I did spend about 15 years in that industry and in that business. Yeah. So it only made sense that if I was going to dive into this field, that naturally I would want to cater to the people who I think I can feel for their pain points and try and find entrepreneurs, business owners, and try and find ways to address those things. And so, now I'm here. I mean, I started out in the industry in the end, what I thought was going to be, this is the independent route. This is the way I wanted to start. Yeah. I kind of always liked the idea of things that were niche and things that were, not so much big box type of things. And so started out in an independent firm, 0 clients, 0 assets under management, and had to build my way up from there. And we're here today. I mean, I won't disclose what we manage or how many households we manage, but I think we're doing relatively well. Yeah. And very excited to keep moving forward, regardless of whatever economic turmoil we're in right now. But it's a very exciting and challenging time, I think.
So you talked about, you started from scratch, and not everyone does start from scratch. For those young entrepreneurs or anyone, in fact, that means something a lot, from starting from a family that did your parents immigrate here from Portugal, or were they already here, or when did they arrive?
Yeah, I think my dad was probably about 14. My mom was about the same. So yeah, the typical story.
Start a business.
Grandma buys a duplex for $30,000 in Mont-Royal, and it's like, And
then go from there.
And then you go from
restaurant business, which is a completely different business than financial asset management.
Yeah, hospitality. We were in the hospitality and the restaurant business, and as much as it's different, the skill sets you acquire in dealing with mass volumes of people in a very short, condensed amount of time, it translates into other elements of your life that I think are super super effective. They're super valuable, right? Dealing with sometimes 1,000, 2,000 people a week, and people typically sit down to eat for 45 minutes to an hour, and you gotta be able to serve each person individually and understand that some people want different type of service. Yeah. And it's no different in investment management. It's no different in if you're a tailor and you tailor suits, or you're a real estate agent and you're
the fundamental principles of business.
That's right.
Excellent. So you heard the intro. I mean, we talked about how times are always different, obviously. Otherwise, we'd be living in a perpetual loop, sort of like Groundhog Day. But, we're living in a period of economic turmoil. We could say that. Probably a period that we haven't lived in, or no one has experienced this, that was born, that's probably 40 years old or younger. So for those, let's say the younger generation, let's call it, say 40 years old, 45 years old, even 50 years old to a certain extent, they haven't lived this sort of turmoil, inflation so high as they're in an adult life. Interest rates rising, tripled almost since March 2022. Stock markets very volatile, cryptocurrency completely erratic. Even commodities had a good year, but even that was somewhat linked to the war. And if you look at gold, which was traditionally like sort of an inflationary place to sort of like house all kinds of wealth, that hasn't glittered so brightly either. So, I mean, this is like a new era. What are you telling people that are looking to invest, to start out in life? Like, is there still is traditional investing still something that people should be looking at? Is there still ways to make good returns when you're starting out in life, or is it like, look, that this is hopeless? I should probably just try to hit home runs every time and throw my money a little bit everywhere that in high risk places, because the returns that my parents made and what we've seen in the past, even pre-pandemic, this is not going to happen anymore. It's a new context. We're hearing a lot about that. What's your position? What do you think?
I think, the stock market is a funny place. I'll say it's a funny place because it's really the only market on earth where when there's a sale, people are literally running out of the store, whereas anywhere else, people are typically coming in and seeing, okay, well, I can get these Nikes at 25% off. It's Boxing Day. I can get this at 50% off. And yet, these companies that sometimes, we don't even think of it that way, but that we support in our day-to-day lives can be purchased at a deep discount. So it's about being able to lift your head up out of the noise and not so much focus on what's right in front of your nose, but rather looking a little bit deeper down the road and trying to assess, okay, what are we facing and how can we position ourselves accordingly? Do I think that traditional assets are going to be, out the window and that it's, a complete reversal of everything that we've ever known economically speaking? No, I think that maybe slight modifications to these things are gonna come up. There's what did we say before? Not decentralization, but there's this disruption.
Disruption,
right?
Yeah, exactly.
Disruption is.
Thank you. I even had a blank. I was looking at you, and I was like,
disruption has been kind of like the buzzword for the last 4 or 5 years. Disruption in tech, disruption in the mortgage industry, people being able to buy things on their phone at
in our lives, social, government disruption.
So I'm not fearful for what's to come. I'm still quite optimistic. I think it's just a function of being more financially literate, less interpretive, right? Because I think we're also in an age of information where we're glued to our phones. We're getting mass influx of information that in most cases no one has validated, right? Yeah. You're on TikTok, you're on Instagram, you're on Facebook, you're on LinkedIn, you're on this. I'm suddenly an author of a 3-minute video that this so-and-so has absolutely no credentials to be speaking on the matter, and yet I trust them because maybe they have 2 million followers. So where people are sourcing their information is largely causing them to behave a certain way. And this is kind of the thing that's being, I want to say, rectified now with the global spanking that we're kind of seeing.
Do you think it's really being rectified though? I mean, really? I think I read a stat that's something like 85% or 90% of people under 25 are getting their financial advice from TikTok. And I think that remains true. I mean, are they really realizing that maybe this is a bad idea? Because I mean, there is some content on those platforms that are actually good. It's just, I think the problem is that how do you know what's good and what's bad? How are you able to weed out the flowers from the weeds? And what would you say to someone like, how do I measure? I hear someone, he has 2 million followers. I hear somebody else, he has 5,000 followers. How do I know that what he's saying makes sense? How do I?
Well, I mean, like anything else, like, if I'm going to spend $50,000, $60,000, $100,000 on a car, research it.
How?
Like you would look it up. You would try and see what are comparable models. You would do the research that you can do online, going through Google, visiting other locations, and kind of doing different test drives and so on and so forth. I'm referencing cars. I'm not really a car buff. I'm just going to preface that with that. But people becoming more financially literate from reliable sources will increasingly allow them to make better decisions and to help them decipher the good from the bad in terms of information that's being shared out there. And by and large, I've never done a cold call in my life in this industry. So, for anyone who's listening, who's like wondering how one goes from zero to where we're at now, it's rooted in financial literacy. We give lectures. We run like curriculums, clinics. We'll call them whatever we need to call them in order to get people into a place where they can hear perspectives from people who are obviously professionals in their industry, and to help them kind of weed out some of the noise that they're getting when they're at home or they're on their devices and so on. Yeah. So being more financially literate, I think, is going to help a lot of that.
Depending on what region you live, do you think verifying that the person that's giving this advice has certain designations or is licensed, or is licensing, because there are some brilliant people out there in business or even in investing that aren't necessarily licensed that are able to do great things. And so you can maybe listen to them or an individual, a young person can listen to them and get good advice. But again, this person is not licensed. He's not supposed to be giving that advice. I mean, there's all kinds of regulatory issues around this. But how do you, I guess my point is that many people are gravitating towards the sort of do-it-yourself model. Like, we'll Google, I'll listen to a couple of YouTubers, I'll listen to this, I'll listen to that, and you know what, I could figure this out. Like you said, we're being bombarded with information. Everyone's a doctor now. I speak to our many doctors that are end specialists that see clients, and everyone comes in already with a self-diagnostic that was aided by Google and a variety of websites and applications. So everyone thinks that, you know what, I can do it myself. I can figure this out. And it's sort of led to this like massive misinformation sort of world that we live in, that you can't weed out what's real and what's not real. So how do you sort of figure that out in investing? Like I hear like research it, but like more specifically, should they be contacting someone that's licensed in their area? Should they be going to see humans? Should we move away from this automation of trying to do it yourself and staying at home in your basement, listen to videos and saying, you know what, I'm good to go. Let's throw $100,000 at this. I mean, what's the solution?
I think that the industry itself is also going through
disruption.
Quite a bit of disruption, and part of that has to do even with the credentials that people carry and what they're able to speak to, and maybe what type of company they're at and what they're able to offer you, being more transparent and so on and so forth. So even that I would take with a grain of salt,
because even people that are licensed or regulated doesn't mean they're doing necessarily a great job.
Unfortunately, you know what I mean. So I would say, counting solely on the fact that somebody has credentials after their name or has a designation after their name, I think it's a good start. But again, I would take a sample, right? I would ask for a referral, a reference, somebody who has dealt with somebody in a similar situation to yourself, right? And a similar experience, and what was the outcome? Like you almost have to go back to that personal route where
get referrals.
I mean,
Google them as well. Double check what the advice they're giving you. Basically challenge. Don't accept whatever someone's proposing to you on straight up.
The first thing you receive.
Yeah, just obviously double check. And we're talking about this because it's super important for the younger generation, as well as, in fact, any generation. You were telling a story prior to us getting on air about someone, and maybe you want to share it here, or maybe you can tell me if you're not, or just a general story that someone invested in cryptocurrency. And finally, this went horribly wrong. Do you want to just share the general outline of like this, the what you encountered?
Yeah, just keeping it again very
vague,
very vague and very general. Someone unfortunately was sold the idea of exceptional returns, and I'm saying exceptional for the time that we were in. This is pre kind of major downturn. And so like the expectation of, even a 10% return seemed lackluster, underwhelming, right? And so was being sold something that was obviously much more opportunistic. We later found out that,
we're talking six figures, good money.
Yeah, we're talking a good chunk of change.
It's not $500 is my point.
It's yeah. And unfortunately, statements also suggested that things were going exceptionally well, but when push came to shove and it was time to cash out, they found out that those funds were actually not accessible, and that those returns were non-realized and non-existent, basically.
The funds didn't exist.
And now to the point where even the initial capital is gone, or is at risk, however we want to call it. It's still, to be honest, in the works. But these are just, unfortunate circumstances that are it's caused by like a mania. It's a mania of people. It's like a herd mentality when people start to slow down. You have to slow down. I mean, like everything is so fast now, right? Like you sort of can't get control of it. It's I don't know. I sometimes I'm like, were my parents moving this fast? Like, days are going by, a million things to do, emails, this, that, problems. Okay, investments. I mean, getting information. Okay, you got to decide by 5. Everything's on a delay, right? Got to decide. So what's your decision? Whoa. Why are we going so fast? What's the hurry? Yet everyone seems to be running all the time. It's because the tempo and the tempo of things and the accessibility to items. It's like, you didn't punch out at 5. You know what I mean? Like, I don't punch out on Saturdays. You know what I mean? Like, it's because we have our phones and we're connected. Do you ever punch out? Or do we ever punch out? You know what I mean? So it's like this perpetual I'm thinking, so it's normal that it kind of feels like you're on this treadmill that's going at 100, but slowing down to make these important decisions. You're buying a house. And for most people, this is the largest purchase that they'll ever make in their lives. Mm-hmm. Take a minute. Let's look at
take a few.
But it's just, you get caught up in this mania and you have to bid on it. You have to pay over asking. You have to. But that's a misconception that a lot of people have, and they're applying the same thing to the housing market as they are to their portfolio. We're going to miss out on this. It's FOMO on that. And what about that sector? And what about this? People are going into the doctor's office with self-diagnosed WebMD type. Take a minute, take a minute to cool things down. You make much better decisions coming from a standpoint of a cooler head and just reflection.
It's a very good point.
Yeah.
Have you ever seen, in most cases for me, when anything is rushed, it's never been, there was no real reason to rush. Most of the time our rushing and our hurrying is not something that's actually real. When you actually look back after the fact, there was actually no rush. It was really self-imposed. So I think that's a good point. Slow down. If you had to give 3 tips, let's say 3, 2, 1, choose a few to anyone that's starting off to start investing for their retirement, whether it be for retirement or for to build up some assets, to build an empire, depending on every individual is different. What would be from your perspective, the top 3, let's say, advice or tips that you would give them?
The top 3 things that I think I would tell anyone who's starting out in investing is know yourself, right? If you're somebody who is impulsive or maybe disorganized, or you may need to have something systematized, right? Something that will be done on a pre-authorized basis, on a monthly basis, to avoid having you kind of get in your own way, basically. So understanding yourself and your own patterns as a person and as an investor, I would say understand that, so that can kind of guide you as to, well, do I need an advisor at this age? Maybe I don't have much money, but do I maybe need an advisor? Because I actually need an intermediary. I need somebody who's going to hold me accountable.
A buffer. And
stay in between me and my next bad decision, basically. That's column 1. Column 2 is, maybe I am totally disciplined. Maybe I can be completely consistent. Maybe I'm okay with a budget and I can commit to X amount of dollars per month. If you are that person, my first suggestion would be, I guess this would be my second suggestion, is automate something on a monthly basis at a minimum.
Consistency
as soon as possible, as early on as possible in your lifetime. And you don't have to break your head thinking about, well, what do I buy and how do I buy it, and so on and so forth. A lot of the platforms that are accessible to the do-it-yourself investors or the self-directed brokerages, whether it's through your banking or through other applications.
Well, simple.
Exactly, of the world and stuff like that make it very simple for you to do so. Find a cost-effective basket like an ETF. I always reference the S&P 500 just because I think it's the best representation of overall economic,
economicness,
economicness, if we want to call it. No, but just overall economic health, I look at those 500 companies as kind of, the how are we doing,
Yeah. Your yearly checkup.
Yeah. And if you could buy that every single month, I have a hard time believing that, in 5 years or 10 years from now that those 500 companies are not doing well, especially knowing that those 500 companies are constantly being interchanged and that's happening automatically within the index. So long-winded answer: 1, know yourself. 2, create something a monthly type of disciplined and consistent approach to investing.
Yeah. I'll say 3.
3. I think,
It's always good to have 3. 2's never enough.
2's never enough. I guess I'm thinking about, it's funny because I'm thinking about young investors, and now I'm trying to think, because I don't have that many that are super young, like young enough to where it feels like a baby step almost.
Yeah. But let's say if they were, because so many people that listen to the podcast and that ask us questions, and we invite them to write to us and write questions on the podcast, or even if they're listening now to write their questions.
Yeah.
They want to sort of know, like, okay, so 1, set up something to be disciplined, 2, be consistent, and then 3
is selecting, in my opinion, and this has been
you're the only one here for now.
I mean from a perspective of like globally, something that has hugely impacted me.
Yeah,
has been selecting a team of people, almost like a board of advisors, if you will, that you trust to help you with affairs. And what do I mean by that? It's not as fancy as it sounds, but I mean, the proper selection of your mortgage broker, the proper selection of your accountant, the proper selection of your lawyer, getting yourself acquainted with not just the individuals, but I mean the jargon that they use, right? The information that they have, their industries, because inevitably it will affect you, So bringing those people in as you're kind of building your wealth, whether it's a small amount or a large amount, I think it's important to start to cultivate those relationships, because they do come in quite handy.
For the third part, build yourself a great team. I think that's great. But you see, it kind of goes against the trend, right? Most people are trying to do it all themselves. They don't want a team. They want to they want it for their mortgage. They want to go on to a website, read for 20 minutes, 30 minutes. And you know what? Okay, I got it. The website's pointing me towards this. I know what to do. I watched a couple of YouTube videos. I'm taking a 4-year fixed. Here we go. For financial planning or investment, I go on Wealthsimple, or I go on a similar site, or whatever it is, the hard bacon, and I get my information. And okay, great. I sort of know what to do, so let's do it, and vice versa, and et cetera, et cetera. Do you think that? I mean, I get there's a model for that, and there's a lot of people that can really dive deep and really go get information and verify it, and they sort of have a passion to do this. But it seems to be more than that. It seems to be like a vast majority of the population wants to sort of like do it yourself, and they're sort of moving away from what I call as our as a species, which is really deep. What I'm going to say is our anthropological success, that all of us have become. We've dominated this planet, sort of like wiped the floor with it in a good and negative way, I guess. Because we've all become ultra specialized. I mean, I can't, there was a time where, one human being had to know how to build a house, had to know how to hunt, had to know how to cook, had to know how to sew clothes and do clothes, had to know how to do all these things. And today, most of us don't know how to do anything except the one thing we specialize at, most of us, which is, let's say in my case, it's finances, mortgages, debt. In your case, let's say investments. You're more talented though. You could probably build things too and cook because you're Portuguese. Dance too, there you go. So you're a rarity, but my point being, we can't be good at everything. And so, Googling your medical thing. Oh, don't worry. I didn't have to go to the doctor. I Googled it and I have this. So I went to order this cream on Amazon and, I burnt a hole through my finger, so, how do you sort of like reach out to people and explain them this, while at the same time recognizing when I tell them that, like, I have a bias, obviously I'm telling you, like, deal with the expert, right? Deal with the expert. But I'm one of those experts that seems to be like, when I say that, it's like, well, yeah, but you have to say that because you're the expert. So how do you get that message across? Like, is there data? What's the answer?
No pressure, Steve. Well, you know
we're
what?
We're talking.
I think that I often allude to the fact that I position myself as kind of the person who knows enough about a certain topic to encroach, right? Because especially in the event that you're dealing with business owners, okay, you don't have that much time. They're not that available.
No, for sure.
So the time that you make, or that they're making to sit with you and discuss, you have to make it valuable. So it's important to understand, like, how much do I need to speak to a certain topic, be it accounting, be it legal structure, be it mortgages, financing, and so on, to address whatever their pain point is now, right? And everybody has, at some point or another, on that sphere, on that wheel of professionals. This is the way I see it, as kind of like a round table of professionals. At any given time, we're feeling the pain at one of those points.
Yeah.
I see myself in the center, where I can speak enough to taxation and to accounting to know or to at least
identify a problem
and articulate to the client or to the prospect that, listen,
There's
think that it should be this, and this. How are you feeling? Like, has your accountant spoken to you about this? If not, I suggest maybe I make an introduction, bring in somebody who I know has dealt with this type of thing before, and see if we can get this sorted out for you, or at least give you another perspective.
Yeah.
And it's the same for structure and legal and mortgages. I never try and step on mortgage brokers' toes, because I know that you're,
Thank you.
I think you guys do your jobs really, really well. But I mean, you can't overstep, because you can also be putting your foot in your mouth. So it's important to know when to pass the puck.
That's very good. Hockey analogy.
For a Portuguese guy who doesn't know how to skate, that's a fantastic analogy.
You can't skate, Steven?
I can't skate.
Oh,
I'm only 36. I'm still learning. The doctor said I'm still growing.
Another reason why you're in detention. Can't skate.
That's right.
Let's talk about the retirement group, because obviously people that are starting to invest today, they're not necessarily thinking about retirement right away, but there is a whole bunch of people that were potentially planning to retire pre-pandemic relatively soon that have reconsidered this, that the markets haven't been favorable for certain people, and others that just didn't get there, and that they're wondering, like, well, I have to work, till they roll me into my grave. Will I be okay? Because if I become invalid, or if I become unable to work, what's going to happen to me? These are fears that are becoming more and more real. It used to be that you had that pension that lasted forever. Now that the Social Security net still exists, but it's becoming less and less effective, with inflation obviously eating away at all that stuff. So, what do you tell someone that's, let's say, age 55 or 65, between that group right now, that's approaching retirement or just entering it, and they're really concerned about what they need to do? Is there something they can do, or they just need to pray? I mean, what's the usually I say praying is not a solution. It's it won't help you very much with your money.
Yeah.
So
it's typically not a solution, but it could be a good start.
Yeah, spiritually, yeah, exactly. But
it's a good start.
Generally speaking, praying won't increase your bank account.
Yeah. I think that often in those types of situations, people often feel as though the situation is worse than it actually is. And what happens is that people tend to look at things in kind of a funnel, in a silo, or a microscope in this case, right? I'm only focusing on this. And they're not really paying attention to some of the other levers at their disposal to help either supplement, modify, or kind of contain the situation.
Got it.
Now, is that a byproduct of financial literacy or lack thereof? Is that a byproduct of just human nature, that we panic and then we focus on the thing that's causing us panic or stress?
Yeah.
Not sure, but it exists nonetheless. So typically this is why, kind of in taking a more holistic approach, and I hate saying holistic now at this point. But it's the most,
if it is,
descriptive
it is what it is.
way of describing the approach. You can help put their mind at ease by seeing, well, what other levers do we have at our disposal that we can potentially, pull on to help either dampen the stress or the income need from your portfolio? Are there supplemental things here that we can look at? Are there government programs that we can look at? Are there spousal or other strategies that we can look at? Are there mortgage strategies that we can look at? There's an amplitude of things at their disposal that they're just not aware of. And I find that that's usually quite a calming conversation, because suddenly you feel like,
okay, there are options.
There's options.
What are some of the things that you see that people are not, like a most common thing, let's say, that they're not aware of that exists that they can do?
Well, I think
the classic, like that seems to, every time you meet a new client or someone that you're like, hey, did you know about this? And they're like, whoa, no, I didn't know about this. Thanks, Steven.
I think that dealing primarily with business owners and those types of corporate structures, that's where we tend to add the most amount of value. So, little tricks in regards to retained earnings and, proper ways to move money around tax efficiently, amplifications of the capital gains exemption and so on. These are all things that that although we're in the industry, so we've heard this multiple times, for the business owner who specialized, let's say, in dentistry, well, he or she only learned dentistry.
Yeah.
They have no idea what the corporate structure is, and maybe, or maybe not, their advisory team hadn't brought it up to them, right? And by team, again, I'm being inclusive in the sense that, you know, the accountant, the lawyer, the financial advisor. So that's in our backyard. That's in my backyard. That's what we see the most regularly. I want to say is that's like low hanging fruit, what I would call it.
Okay, so that's something that you would see a lot, and that obviously helps to get them out of, not out of, but looking at different directions to sort of like optimize whatever they have to do.
Yeah, because a business owner's, you know, main concern is typically not making money, because they know how to make money. They go in every day, they clock, and they know how to run a business. Their main concern is keeping money. Their main concern is paying minimal amounts of taxes. Their main concern is transferring the wealth over to the next generation as efficiently as possible, or keeping it going, right? Yeah. Selling, or either you're exiting or you're transferring. And in none of those cases do they care if the S&P 500 is up or down.
True.
Right?
Yeah.
And yet that's where everyone's mania is. That's where everyone's thinking, where it's like, well, if we can shift some of this focus to all of this, what does that actually translate to from a dollar figure? Yeah. And then as a percentage of the whole, in terms of your net worth, right, and your wealth, what does that look like? Right? If you're amplifying a capital gains exemption at $916,000 and suddenly it's amplified by 2 or 3, I think it's a little more interesting than you making, whether you made a 7 or a 10% return on your portfolio.
So, you know, one thing is that, just like we said, mortgage is not all about rate. Obviously, an investment, it's not all about return. And this is a classic mistake. You're just looking at one number, not looking at the overall wealth. What you want to look at is, you know, how much you actually making as a whole, not necessarily what you're doing as a return. Because at the end of the day, if you remove taxes, remove strategy, remove all these things, well, it doesn't matter what return you're making as much as are you more or less wealthy, depending on strategy A or strategy B. And that's pretty much sort of what you're aiming at.
Yeah, and also, I mean, I think the definition of wealth has also evolved to include your well-being and your health.
True.
So at this point, like, if for you to have something that is super performant, but you're not sleeping at night, what's that worth to you? How many years do you think that's shaving off of the tail end of your life? And is that really worth it? The reality is none of us are taking any of this money with us after the fact, right? So it's about enjoying the time that you're here, making these things work for you as efficiently as possible, right? Which requires what? Maybe you taking a minute to stop, slow down, breathe, consult with your team, bring in the right individuals at the right time. Don't try and wear all the hats. Because it looks goofy. I don't know if you've ever seen somebody wear one of those stacks of hats. It's a goofy look. But get past the puck, hockey analogy again from the guy who can't skate, to the right person at the right time.
That's a good point. Yeah. You're an innovative guy. I mean, I recognize you for being very innovative. You know, that's a compliment to you. So
thank you.
What in terms of investments, I mean, I know that you've transformed your career from where you started to always look at, you know, let's say the niche, not necessarily the niche, but different. Where can I invest my clients' money, or what can I do as a chartered investment manager to sort of do things differently, more optimally? What are you seeing now in terms of opportunities or investment vehicles that are outside of the known? You know, what is a little different? You know, some people look at REITs, you know, or real estate investment funds. Or trusts in this case. What are your suggestions on that front? So what's like the things that you're looking at that are interesting right now?
So those were always a very interesting vehicle to me. I mean, this is also somebody who grew up with an affinity for real estate. You know, when I was squirreling away those bucks, I was buying, you know, a unit or a building every year for a little while, and I remember seeing my parents, ask me like, "When the hell are you moving out?" And I was like, "No, I'm staying home. I'm going to buy as much real estate as possible. Keep buying real estate and keep buying the pancakes." Yeah, exactly. And I would tell you, like, when I would invest at that age, that I was investing in, companies and businesses that we used on a day-to-day basis. If we had our cheese supplied from somewhere, or if we banked at a certain place, then I'd rather own shares. And I always saw it as like, well, if I can offset
invest what you know and what you know.
Yeah, or if I can offset the price at the pump by owning Esso, if the Esso's not publicly traded, but you understand what I'm saying?
Yeah.
Then I would always think that way. So for a long time, especially up until recently, I really liked having access to private passive real estate. Okay. Now, the kind of the term that I've coined is a deconstructed REIT. Okay. So
explain.
There's real estate, as you know.
First of all, what is a REIT?
So a REIT is a real estate investment trust. Now, there's public REITs and there's private REITs. Now,
what's the difference?
Well, basically, on the public side, they're publicly traded. They're tradable on any of the stock exchanges. On the private side, however, these are basically structured as either LPs, or a variety of different structures are available. There are trust structures as well. But they're not traded on the stock market. Thus, their price tends to not fluctuate on a day-to-day. Full stop. The interesting thing about that is being able to detach yourself from investors' emotions, the herd who can go in, click sell, click buy, and kind of drive prices up or down. That's what I've always found interesting about it. But what I found interesting from a manager's standpoint is to say, well, how many different ways do we know real estate, right? And then how many different ways can I partake in it, or can I invest in it passively to diversify myself, in a said space.
Yeah.
So when I started thinking about developing this type of deconstructed REIT kind of thematic, I started with saying, well, how many different ways can we invest in real estate, right? There's multi-residential, there's commercial, there's industrial, there's farmland, there's healthcare, there's
a whole variety.
There's a whole variety. And you see kind of how now suddenly you're not just saying I'm investing in real estate. There's like an amplitude of different ways that we can get involved. So I always found that very interesting. I also started to develop that thought because over the years, like I mentioned, acquiring physical brick and mortar, I quickly realized that although I'm Portuguese, I'm actually manually inapt. I am not good. I can barely hang a picture on the wall. So I keep thinking about the longevity of these buildings, and I keep thinking if I don't scale these things to a certain level where I can afford to hire a management company, I'm going to have to
get killed,
and I'm going to have to get rid of them at some point. So further exploring the passive route was a very interesting exercise, even just for myself personally, right?
Interesting.
And I mean, I'm speaking for myself, but then again, I don't know a wealthy individual who hasn't incorporated real estate into some element of their net worth, right? It's often a cornerstone piece in anybody's portfolio. So the whole aspect of private investments and stuff like that, it fared super well during COVID because, again, people couldn't panic sell. So the illiquidity of that asset class actually
slowed people down.
It forced you, right? Because there's somebody at the gate saying, no, sorry, we can't take any redemptions until
it's not that liquid.
next month, right? Or next quarter.
Let them time to think.
And let the market time to react, to overreact, to heal, to do whatever we want to do. Or in this case, let the government inject a ton of gas. Anyway, we can get into that. But so that served super well at that time. What I'm seeing today is I still see great businesses. I just ask myself whether or not there's as much value in holding illiquidity in a time when publicly traded companies, liquid companies, accessible companies are trading at a discount. So it may be just a question of recalibrating. I don't think I'll ever get out of the private space, but teetering the scale a bit to take advantage of some of these what I think will be long-term opportunities.
Do you think it's bottomed out? I mean, obviously that's a hard question. What is bottomed out? Like on average, I guess we're at the lower end of an average.
Look, bottoming out. I mean, there's always surprises, right?
There's always room to go lower.
There's always room to go a little bit lower. I mean, and we can pretend to try and drive the car through the rearview mirror, but you know, it's not typically the best. It's not typically the best way to go about it.
You'll probably hit something that you don't want to.
A couple of things, exactly. You have to go into it anticipating a little bit more volatility potentially, right?
Got it.
How you interpret and how you act should be a function of what your needs are. If you need the money tomorrow, right? I'm telling you, listen, let's sit this one out. If you need the money at the end of the year, at this point, higher interest rates, yeah, okay, they suck for a lot of people, but if you can suddenly get a locked-in GIC at 3, 4, 5%, well, it starts to become a little bit more interesting.
Yeah.
It doesn't have to account for your entire net worth, your entire nest egg, but you want some security, and now some of those options are becoming more and more viable for investors. And again, that typical person is either buying a house very soon, needs the liquidity for whatever reason, or is retiring.
Yeah.
So that's kind of my thought on just on that, like what
on the REITs and all that. So, but what I mean, the REITs is one thing, but what do you do with like a out of the box with clients? Is just a REITs like you were talking about? We were talking about out of the box investments because you know you're I find you an out of the box guy. So what else do you look at usually to say, okay, what else can I do that most people don't to bring value to a portfolio? Another option, because I think it's really important, because a lot of people are just always in their traditional, like, I'm just going to put RSPs, I'm just going to put this, and we're trying to just like provide them information, education. I'm thinking, look, there are other options. There are, talk to your financial advisor, talk to a Steven Furtado of this world, contact them and ask questions. Just doing what everyone else is doing and listening to videos and then taking risks that are not necessarily measured risk, or it's not really, it might not be worth it. So get informed. And so, what else would you say would be an interesting sort of a investment to look at right now? Like, Steven Furtado, I'm giving you $100,000 today. I want you to invest me in something. What would it be?
Well, Ryan,
$1 million, let's say. Okay, now is it more interesting for you? You gave me a look like saying $100,000.
Well, Ryan,
you useless man. $1 million. Now it's more interesting.
Yeah. So, if you want my honest answer to that is that I don't have a portfolio for you yet, because the reality is, I don't let the portfolio dictate your plan. I let your plan dictate the type of portfolio you want. And although a lot of people come in often thinking...
Are you going into politics soon, or...?
Can you tell?
Keep going.
The Believe in Steve campaign 2023.
Yes,
can you believe it?
Believe in Steve.
Believe in Steve.
I believe in Steve. Continue.
Just kissing
You're
babies.
You're good at political answers. I
appreciate that, but it'll make sense.
You pivot very well.
It'll make sense in a second, because again, naturally, like it's the person coming into the doctor's office almost with a diagnosis, right? Like I can't give you a diagnosis if I haven't diagnosed you. I haven't spoken to you. I need to know, I need to check everything. If I really want to make this into something that is not just a plan that is, investment driven, but a plan for longevity, because I'm not looking for customers. I'm not looking for a transactional relationship. I'm looking for clients that I can see through from now to the next 30, 40, 50 years. As long as I can, read and write and I guess articulate is probably...
Those are the three good requirements: read, write, and articulate.
And notice I didn't say hear. I should probably add hear to that. Hearing. Yeah.
To that, I mean, there are ways around every single one of those. But
But listen, I don't spit out portfolios on the fly. I tell people, listen, we got to go through.
It's very responsible of you.
Understanding everything that you're currently doing, what you've done in the past, understand what didn't work, because we're here today.
Yeah.
And then see how and what you need moving forward. Because if you're in a position where you don't need to take excess risk, or we have a timeline crunch, or there's a need for income, your portfolio is going to be tweaked accordingly, or is going to be modified accordingly.
Yeah.
But yeah, that's typically my. So it's not like, hey, let's do these 5 stocks. It's really not that.
No, because there's so many YouTube videos about that right now. Like, these are the top best stocks, and So, I'm going to go all Warren Buffett on you. A lot of people talk about value-based investing, and a lot of people don't necessarily understand what that is. So let's ask the question. Let's try and answer that question. What is value-based investing? What is that concept based, in your opinion, in a simple way that doesn't drive us down the rabbit hole? Value-based investing, for those who are listening to us, how do I find value in the stocks or investments that I buy? What do I look for?
Well, I think there's, you can always use the Graham model to kind of calculate whether or not a company is trading below its whether it's underpriced or overpriced and so on. But the way I read value is a company that is either relatively or slightly underpriced to the current market.
Yeah.
But that I'm not necessarily looking for hyper growth. I'm looking for stability. Right. So when I think of value, I'm thinking of some of these, institutional type, businesses that you can invest in that you believe will be there for the next decade or so.
Like companies like what do they call them?
Typically like dividend payers and stuff like that. Like these
legacy companies kind of thing. Like Coca-Cola, Johnson & Johnson type thing. That like this is sort of like they're there. They're going to be there. We're buying their products. They're still going to be selling products.
Whether you know it, like it or not, they're
so integrated ingrained. That's the word. Ingrained in the fabric of the functionality of society and our consumption that it would be very difficult for these companies to disappear completely.
Yeah, and I understand that that's not the technical definition of value investing necessarily, but when I look at companies, anything that I deem to be valuable, whether it's a stock,
value-based investing,
anything that I deem to be valuable is something I want to hold long term. Right? If a soccer jersey that's autographed to me is something that I'm willing to pay for, it's because I'm willing and I find it valuable. It's because I'm willing to hold it long term. I just apply that same kind of thought when I'm looking at companies, because I'm not really looking at them as companies. I'm looking at them as businesses, right? So yeah, value to me is something that is ingrained in our everyday and that is relatively large, and then we're not looking for hyper multiple, digit growth like a tech stock or anything like that.
Got it.
Mind you, a lot of those may be considered value in the future, right? Like, I mean, Apple has kind of taken over our lives, and as well as a lot of the other big names. So, but anyway, that's my kind of 2 cents on that.
Let's dive into the big word of 2022. If you had to choose the big word in 2022, what do you think it is?
Recession.
Well, that's 2023 probably, but 2022 was inflation. I think maybe.
Oh yeah.
Maybe this year throughout 2023 we're gonna see a recession for sure. But let's talk about inflation. Where do you think inflation is heading? Globally, certainly, and then locally. How do you see that playing out? With all the factors that you see, and what factors do you see playing in that? Because most people, that's what people are talking about. That's what the videos are saying. I mean, it's obviously you're reading a lot of information there. What are you reading? What are you hearing on this topic, inflation, and how do you think that's going to play out for the rest of 2023?
I mean, I don't like to be overly optimistic on the fact that the last well. You have to take it with a grain of salt, because I could be overall optimistic without being necessarily optimistic on just a number, right? So the 6.9 or whatever that we got from the US, I think on the last reading was
something around 6.9 right now, exactly. Yeah.
Was seen as quite optimistic because it came down a notch, right?
Yeah.
But I think we can all agree that there's likely still a couple more hikes in the horizon. I don't think it's at the point in which they want it to be yet. So I don't think it's under control, basically. Not yet. So I think the Fed still has a couple of levers that they can pull. I think that's something that we're going to endure. When earlier on when we spoke about, do you think we've bottomed out? Well, I think that this is obviously going to play a lot into as a deciding factor as to how much more volatility we're going to get.
Don't you think it's so volatile already? I mean, the Fed comes out and says one thing. Their speak says, we think we're heading towards the end, or the Bank of Canada, TIF, I see the end and right away the markets fly up at the slightest news of good news, and the second, I don't think I'm going to be willing to act quickly and continue to rise if necessary, and all of a sudden, they reverse. I mean, extremely, extremely sensitive to any sort of comment. We were talking about slowing down. Like, how do you sort of like navigate in a market like that, where no matter what happens, like every little word, everyone just freaks out about it, doesn't it? Like, sort of drive you a little crazy when you're screaming like, everybody slow down and relax and let's see how it develops. How do you keep people calm?
It goes back to those three things that you were asking me about. My 3 tips, Steve's 3 tips on investing, and
we're gonna play that back when we cut this up, and we're gonna play the clown music behind, like you're gonna be juggling. It'll be perfect.
The 3 tips floating around. No, but I think that. I don't get many phone calls, man. I don't get many phone calls.
That's probably not good news.
I don't get many phone calls
from
clients saying like, the Fed is this, or the this happened or that happened. Like it doesn't really happen, and it's because of the financial literacy that we try to impose on clients.
Yeah,
you're gonna work with us. You're gonna become smarter, because you becoming a smarter investor makes my solutions make a lot more sense. And as long as you feel as though you're in control and that you understand your money, which a lot of people already don't, they feel as though they're making better decisions, they're more confident, and they can stick to a plan. It's when there's incertitude, that's when people start to derail a bit and start to panic and start to go rogue on making certain investment decisions and stuff like that. So how you kind of avoid the craziness of CPI numbers and non-farm payroll numbers and all this other stuff, you set an emotionless, mindless monthly purchasing strategy that no matter what you do,
you're sort of looking for dollar cost averaging.
You constantly have a dollar cost averaging strategy that's being applied. You can do your lump sums, you can do your quarterlies, you can do your at the end of the year your RSP top ups and so on and so forth, and we encourage people to do so. But the greatest gift that you can give yourself, even in your older stages, is remaining consistent with a effortless and emotionless is I think the key word. Strategy, which is buying it high, buying it low, just buying it consistently on the same day every month, and
linear growth over time. Remove some risk, hedge against risk, and that's your
and focus on taxes and focus on the things that you can control.
Perfect.
Ultimately, it's funny because the one little anecdote that I didn't mention to you about my past was I had spent like a 2-year stint at a hedge fund prior to getting into the retail side. I thought you were going to say something as a go-go dancer in Vegas, and I was like, oh God. That was one afternoon.
That's two shots in, and
that's it. I wasn't even paid.
You are a cheap date, that is true.
I wasn't even paid for that. But
the best things in life are free, Steven.
That's right.
The best things in life are free. Continue.
But in being in that space, and I'm thankful that I got to have that experience, because it taught me quite a bit. One, it taught me that was not the environment that I wanted to grow in because of that nature, right? You're basically macro obsessed, and it's about data and it's about all this stuff. So 8 screens, scrapers scraping Twitter and scraping Facebook and for keywords and all this stuff, and reading the Fed's language from the previous thing.
Always interpreting, always looking for trends.
Every single word. And we used to have this it was like a program that we had created that would interpret the MVAR of any number that would come out. The MVAR is the magnitude of variance. Okay, so if the CPI number was supposed to be 5 and it came out to be 5.1, well, how much of an MVAR, how much was that deviated from, how much of a variance was that?
Yeah.
And you would only get that variance by, again, scraping on Bloomberg and Reuters and all this other stuff. And it would just basically give you a sell or a buy, right? And you're in and out of a position in 30 seconds.
Jesus.
So it's thrilling in the moment, but then you realize, shit, I have a couple of mortgages due. I have kids. I have, you know what I mean? Like I can't afford to live this kind of like this
nonstop all the time.
Years off of my life. I can't do this kind of thing long term. So I found that interesting because in my first year in the industry, I was coming off of that stint.
Okay.
And so, driving alpha and returns was like the first thing that I thought I had to do. And then in speaking to my target market, I quickly realized that they're like, whoa, I don't need you to do all that. Yeah. I need you to be smart around the tax stuff. And then I started to think back to, okay, well, what bothered me again as a business owner? What bothered my father as a business owner? And then I was like,
you sort of merged it all together to make a happy
I'm
sauce.
going to shift the strategy. Can we cut out happy sauce?
Look, man, sometimes happy sauce is a good thing. I mean, look, this is a family show.
Interview over.
PG-13. All right, I don't know, maybe 16. But it's going downhill.
It's rapidly descending. All to say that quickly tweaked my strategy to say like, okay, I'm glad that I understand that. I'm glad that I had that experience, but it's not applicable to the demographic I'm looking to cater to. They don't need me for that. True. And quite frankly, I'm not getting into this to continue doing that because it's not sustainable.
Yeah.
And you see that when you look at the fact that, 90% or whatever the crazy number is of managers that aren't even beating the index.
Which is insane. Yeah.
Right.
If you think about it.
So
that's what a lot of the clients use when the argument for like, look, I could just do this myself. Look, all these managers with all these degrees and fancy letters don't even beat the index. So why do I need that? Why do I need to pay heavy fees? And because that's to your point. Because if you're paying fees for returns, then maybe you're right. Maybe you shouldn't be paying fees. But if you want advice on a complete portfolio that matches all aspects of your financial plan, that's why we're here.
And not just that, but the point number one on the three things is understanding yourself. If you're not going to hold yourself accountable and if you're not going to do those things, then I don't care what Questrade says on their infomercial. You're not retiring 30% richer if you're not doing some of these simple, basic things.
And sometimes you need a coach to get that done. But just like no matter what anybody says, they ask me, Ryan, why do you have a trainer when you go to the gym? And I know you work out as well. It's because it keeps me accountable. And you know what? That accountability costs some money, but at the end of the day, it pays dividends. And so when you have a coach that's always in your corner, reminding you, pushing you, making sure that you're there, making sure you're doing what you got to do, no matter how disciplined you are, that coach can always get you more disciplined and bring something that you didn't think of. 2 minds are better than 1, 3 are better than 2, and 10 are better than 1. I mean, it's just simple math. So it's a very good point. And,
and it's a humbling experience. Like being somebody who has also played sports and trained my whole life. As soon as I started working with a trainer, I could right away identify in the 60 minutes that I'm training. 5:30 in the morning, I'm there and I'm training. I can quickly identify this is exactly when I would step out of the gym. Like I've had enough at this point. Yeah. Okay. Minute 42.
Exactly.
You know what I mean?
I would stop right now. It's those last 10 minutes. That's not the first steps. It's the last steps.
Correct.
Just that extra push, that little extra that over 5, 10, 15, 20, 25 years makes a difference in your health, but will make a difference in your portfolio as well.
Absolutely.
It's a nice way to end this. Steven.
Are you telling me it's over?
When you were joking before and you said that, you got to tweak your strategy, for some reason, like that sounded dirty to me. And then I started,
I saw you giggling and I just looked away. And I didn't want to make eye contact.
So you know what? I'll ask you one more question before we close it all up here. And it's a yes or no question.
Okay.
Buy real estate to live in 2023, yes or no?
In Montreal?
In Canada.
In 2023. That is a good question. I would still say yes.
So you're on the yes side. On the yes side, obviously, no matter what we say, it always depends, and it's case per case. But that's very interesting and a good answer. I think I agree as well. If you're thinking long term and you're being patient, as long as you're thinking correctly and analyzing the purchase and it makes sense, then yes.
Yeah, the purchase of a house doesn't mean go out and overexert yourself or overexert your budget.
No,
to be clear,
exactly.
Because it
depends. Yeah, yes, anything.
Yeah, this is the situation a lot of people have put themselves in. So, disclaimer like that. But yeah, of course. Like, I mean, if it's your family's growing, there's things that inevitable life events that occur that force you to kind of get into another space or unfortunate events as well, buying a house is still going to be an essential part of
your financial life.
Exactly. So if it happens in 2023, just make sure that you plan accordingly around it so that you don't end up house poor.
Very good point. Steven, it's been great. Thank you for your insights, and I wish you much success in your ongoing trials and triumphs. You've brought a lot of great insight into my business and my professional career, and I enjoy working with you a lot. And I hope that you'll come back and visit us here on Detention or La Retenue. Donc, merci d'avoir été avec nous.
I'll be back in detention
shortly,
I'm sure.
Amazing.
If history repeats itself.
It tends to do that. Thank you.
Thanks, Ryan.
Merci d'avoir été avec nous pour cette retenue. Je vous invite à nous suivre sur Facebook, Instagram, YouTube et les principales plateformes de podcasting, Spotify, Apple Podcast, Google Podcast. Et si vous connaissez un cancre financier, dites-lui de s'abonner à ce podcast. On se rejoint à la prochaine retenue.